Hello, I'm Dr. Elias Iskender. Today I'll be analyzing one of the most critical questions in modern finance. Are we repeating the mistakes of 2008? The global financial architecture is witnessing a dramatic resurgence of credit risk transfer mechanisms. Banks are increasingly using instruments called significant risk transfers, or SRTs, to move risk off their balance sheets and obtain regulatory capital relief. And this inevitably raises comparisons to the collateralized debt obligations that were at the epicenter of the 2008 global financial crisis. The question everyone is asking, is the SRT market the next CDO crisis waiting to happen? Introduction: the evolution of securitized risk. The mechanism of transferring credit risk from regulated deposit institutions to broader capital markets is a fundamental pillar of modern finance. Theoretically, this enhances financial stability by dispersing concentrated risks and allows banks to channel capital into new lending. However, the history of this mechanism is divided by the traumatic fracture of 2008. Today, I'll analyze two distinct manifestations of this financial innovation and the economic incentives underlying them. The legacy of 2008, the CDO trauma. The 2008 financial crisis was, in many ways, a securitization crisis. The proliferation of private label mortgage-backed securities and their repackaging into CDOs created a complex web of leverage and opacity. Rating agencies, incentivized by fees paid by issuers, granted AAA ratings to security tranches whose underlying collateral was low-quality subprime mortgages. When the underlying collateral, primarily U.S. residential real estate, began to default, the correlation between these assets proved far higher than the Gaussian copula models of the time had predicted. The result was a catastrophic cascade of downgrades and write-downs. Approximately one-third of downgraded AAA tranches experienced severe losses. The pre-crisis CDO market was dominated by arbitrage CDOs designed to capture the spread between high-risk asset yields and the lower funding costs of rated obligations. This structure fed the originate-to-distribute model that incentivized originating low-quality loans solely for securitization purposes. Banks and lenders held little or no economic interest in loan performance after the loans were sold, severing the link between underwriting standards and credit performance. The rise of significant risk transfers. In the post-crisis period, the regulatory pendulum swung toward higher capital requirements. The Basel III framework mandated that banks hold significantly more core capital, Common Equity Tier 1, against their risk-weighted assets. In response, banks turned to SRTs, also known as credit risk transfers or capital relief trades, primarily not to provide funding, but to manage these new capital constraints. An SRT is a transaction where a bank transfers the credit risk of a specific asset portfolio, corporate loans, SME loans, trade finance, etc., to investors through a synthetic securitization structure, typically involving credit default swaps or credit-linked notes. By transferring the risk of the first loss junior or mezzanine tranches to investors, the bank can reduce the risk weight applied to the retained senior portion of the portfolio, thereby freeing up regulatory capital. Structural mechanics, the anatomy of divergence. To understand the divergence between 2008 CDOs and 2024 SRTs, we need to dissect their structural anatomy. While both use tranching technology, the geometry of the tranches, cash flow, and ultimate location of risk differ significantly. The 2008 CDO structure, opacity and arbitrage. The archetypal 2008 CDO was typically a cash structure or hybrid structure. A special purpose vehicle would purchase a portfolio of assets, usually subprime RMBS bonds, and issue obligations in tranches. Collateral, the assets were frequently other securitized products, creating securitizations of securitizations or CDO squared structures. This created layered opacity. A CDO squared investor could be indirectly exposed to thousands of mortgage loans, but analyzing each individual loan became virtually impossible. Tranching and super senior. A critical feature was the massive super senior tranches comprising 80% or more of the capital structure. Banks often held these on their balance sheets, believing the tranches were risk-free. However, because the underlying subordination was thin and default correlation was high, when junior tranches were wiped out, these super senior tranches experienced massive losses. Funding. The primary purpose was usually funding arbitrage, raising cash at a lower cost than asset yields. The modern SRT structure, synthetic and on-balance sheet. Modern SRTs are predominantly synthetic securitizations. The bank keeps the actual loans on its balance sheet, maintains the customer relationship, and transfers only the credit risk. Collateral. The underlying assets are risks from the bank's core business: large corporate loans, SME loans, trade finance, and increasingly fund subscription lines. These are not arbitrage assets purchased for repackaging, but assets originated with the intention of holding them on balance sheet. Tranching and the mezzanine. The focus of an SRT is the mezzanine tranche, first loss, equity junior, typically 0% to 1-2%, sometimes retained by the bank to align incentives or sold to specialists seeking high returns. Mezzanine typically covers losses from 2% to 10-12%. This is the tranche sold to investors, hedge funds, pension funds. It's thick enough to absorb significant unexpected losses. Senior. The bank retains the senior tranche, e.g. 88% to 100%. The goal is to reduce the risk weight of this retained senior portion from, say, 100% to 20%. Mechanism, credit-linked notes. The bank issues a note to investors. If the portfolio performs, investors receive coupons. If defaults occur, the note's principal is written down to compensate the bank. Bilateral guarantees. A direct contract where an insurer or guarantor agrees to cover losses in exchange for a fee. Let me show you a comparison table. 2008 crisis. CDO motivation was arbitrage funding fee generation. Underlying assets were subprime RMBS and other CDOs. Assets were sold to SPV, true sale. High opacity with CDO squared and blind pools. Minimal or no retention, originate to distribute. Leverage embedded in structure plus off-balance sheet SIVs. Light touch regulation. Modern SRT 2024. Motivation is regulatory capital relief and RWA management. Underlying assets are corporate loans, SME loans, auto loans, trade finance, assets kept on bank balance sheet, synthetic, high transparency with loan level data and ESMA templates, mandatory retention, 5% rule plus senior tranche retention, investor level leverage with back leverage concerns, Basel III IV, STS framework, strict supervision, regulatory catalyst, Basel III and the endgame. The resurgence of the SRT market is a direct adaptation to regulatory pressure rather than an organic market phenomenon. Implementation of the Basel III framework and the approaching Basel III endgame, or Basel 3.1, has significantly increased the amount of capital banks must hold, capital relief mechanics and RWA optimization. Under Basel rules, banks must finance their assets with equity capital at a certain ratio. For example, corporate loans may be subject to a 100% risk weight under the standardized approach, meaning the bank must hold $8 of capital or more for every $100 of loans. In an SRT transaction, by purchasing protection on first loss and mezzanine tranches, the bank effectively converts the risk profile of the remaining portion of the portfolio, the senior tranche, into an AAA-rated exposure or better. In this case, the risk weight of the retained senior tranche can drop to 20% or lower. This allows freed up capital to be returned to shareholders or used for new lending, increasing return on equity. The commensurateness test and qualitative criteria. One of the most critical post-crisis measures introduced is the commensurateness test. Regulators like the ECB and Fed require that the amount of risk transferred to third parties be commensurate with the capital relief claimed. Quantitative control. Banks must prove that capital relief is not excessive compared to protection cost and risk transferred. If a bank transfers a very thin risk slice and claims massive capital relief, it fails this test. Thickness tests. Regulations specify that sold tranches must have minimum thickness to genuinely absorb losses. The European Banking Authority implements specific tests for mezzanine and first loss tranche thickness to ensure risk is transferred practically, not just theoretically. Qualitative requirements, criteria like legal certainty of the transaction, objective definitions of credit events, and restrictions on early call options are mandatory for SRT approval. Basel III Endgame Impact. The Endgame reforms, expected to take full effect in 2025-2026, introduce an output floor that limits the extent to which banks can use internal models to reduce capital requirements. This floor will increase RWA for many banks, thus fueling demand for SRTs as a tool to alleviate these higher capital burdens. Asset quality and incentives, the skin in the game. Revolution. The deepest difference between the two periods lies in the quality of underlying assets and the alignment of incentives between issuer and investor. This must be examined through the lens of moral hazard and asymmetric information literature. The originate to distribute failure of 2008. The 2008 model was based on the originate to distribute principle. Mortgage lenders knew they would sell the loans they originated to investment banks for securitization within days or weeks. Consequently, underwriting standards collapsed. Ninja loans, no income, no job, no assets, became widespread because the originator didn't bear long-term default risk. Moreover, the assets composing CDOs were typically subprime, loans to borrowers with poor credit histories. These assets were extremely sensitive to economic downturns, especially housing prices, and highly correlated with each other. When national housing prices fell, the diversification benefits assumed by CDO models evaporated. The balance sheet management model of 2024. In contrast, SRTs typically reference core bank assets, large corporate loans, established SMEs, or diversified consumer portfolios like prime auto loans. Asset quality. These are loans the bank originated with the intention of holding. The bank's primary business is lending to these customers, and the SRT is a secondary optimization tool, not the raison d'etre of the credit. Ongoing alignment. In a synthetic SRT, the bank keeps the loans on its balance sheet. It continues to service the customer and manage the relationship. If a bank aggressively forecloses on a customer to trigger a payment from an SRT investor, it harms its own brand value. This implicitly aligns the bank's interest with the investors. Prime versus subprime. While some SRTs reference riskier assets like leveraged loans, the bulk of the market, especially in Europe, focuses on performing corporate and SME books that have historically had much lower default rates than subprime mortgages. Risk retention rules, post-crisis regulations, Dodd-Frank in the US, the securitization regulation in the EU, legally mandated skin in the game, the 5% rule, originators must retain no less than 5% of the net economic interest in the securitization. Vertical versus horizontal retention. Retention can be vertical, 5% of each tranche sold, or horizontal, the first loss tranche. In SRTs, banks typically retain the senior tranche, 80–90% of volume, and often part of the first loss tranche. This means their economic exposure is far above the regulatory minimum. Incentive alignment. Economic theory suggests that retaining the first loss piece is the most effective way to prevent moral hazard. While banks sometimes sell first loss in SRTs, regulatory scrutiny and the thickness of sold tranches ensure the bank cannot simply walk away from credit performance. Investor landscape. From monolines to specialist credit, the stability of any risk transfer market depends on the capacity and sophistication of investors absorbing the risk. The 2008 crisis was intensified by the fragility of the investor base. The 2008 investor base, fragility and naivety. In the run-up to 2008, a significant portion of CDO tranches were purchased by structured investment vehicles, SIVs, off-balance sheet entities set up by banks that borrowed short-term commercial paper to buy long-term CDO assets. When the market turned, they faced liquidity runs and were forced into fire sales. Monoline insurers, specialized insurance companies that wrapped super senior tranches. When losses materialized, monolines had insufficient capital and collapsed, rendering their insurance worthless. Naive investors. Many investors relied entirely on rating agency ratings, AAA, without conducting independent due diligence on underlying credit bands. The 2024 investor base, sophistication and diversification. Today's SRT market is dominated by a different class of investors, specialist credit funds, funds with deep expertise in credit analysis, typically managed by large asset managers like Ares and Blackstone or specialist firms like Chorus Capital. They often conduct loan-by-loan due diligence before investing. Pension funds and insurers. Large institutional investors use SRTs to access diversified credit risks that are difficult to source directly, like European SME loans. These investors typically have long-term liabilities, matching the maturity of SRT assets, reducing liquidity run risk. Hedge funds, active in junior equity tranches where returns are highest, targeting mid-teen IRRs. While their participation brings leverage concerns, they are generally more sophisticated than 2008's SIVs. Leverage and systemic interconnectedness, the returning ghost. While structure and assets have improved, the specter of leverage remains the most significant systemic risk associated with SRTs. The 2008 crisis was a leverage crisis. 2024 SRTs are not immune from this dynamic. Back leverage and funding circularity. A growing concern among regulators, the IMF and the Fed, is the use of leverage by SRT investors. Mechanism: a hedge fund wants to buy an SRT mezzanine tranche yielding 10%. To amplify returns, it borrows leverage. Who provides the money? Often, a large bank's prime brokerage unit. Circularity risk: if Bank A issues an SRT to reduce its risk, but Bank B lends to the investor to purchase it, the risk hasn't left the banking system. It's just moved from Bank A's credit book to Bank B's prime brokerage book. If Bank A finances the investor itself, though typically restricted, this is structurally possible through indirect routes. The risk transfer is illusory. Regulatory response: in 2024, banks like Citigroup have begun imposing strict funding source restrictions on their SRTs to prevent this circularity, prohibiting investors from using repo or NAV lines provided by the issuing bank or even other US banks. The IMF has warned that this back leverage can create negative feedback loops, echoing 2008's interconnectedness. Comparison with 2008 leverage. In 2008, leverage was embedded both inside the product, CDO squared, and outside through SIVs. In modern SRTs, leverage is primarily outside at the investor level. Estimates: some hedge fund industry estimates suggest 10 billion euros of leverage are used to finance 60 billion euros of SRT transactions. While significant, this is arguably far less than the massive leverage ratios, 30x, 40x, seen in pre-crisis SIVs. Transparency of leverage: prime brokerage loans are collateralized and margined. Unlike 2008, when leverage was hidden in off-balance sheet vehicles, modern banks' loans to hedge funds are subject to their own capital requirements and stress tests. Transparency and valuation: the STS framework. Opacity was a defining feature of the 2008 collapse. Investors didn't know what was inside CDOs. The 2008 black box. CDO prospectuses were hundreds of pages long but often lacked detailed data on underlying borrowers. When the market turned, price discovery became impossible because no one could value the underlying assets. This uncertainty caused liquidity to freeze. 2024's transparency post-crisis regulations mandate high levels of transparency. ESMA templates. In Europe, the European Securities and Markets Authority requires detailed disclosure templates providing loan-level data for securitizations. STS label. The simple, transparent, and standardized framework allows certain synthetic securitizations meeting strict transparency and simplicity criteria to qualify for preferential capital treatment. This incentivizes banks to create cleaner, more transparent structures rather than the complex black boxes of the past. Bilateral due diligence. Because many SRTs are private, bilateral deals between a bank and a sophisticated investor, the investor typically demands and receives full data room access. This enables bottom-up credit analysis absent in 2007's public CDO market. Market size comparison, 2007 versus 2024. Comparing volumes provides context on systemic magnitude. The 2006-2007 peak. In 2006, non-agency RMBS issuance, the raw material for CDOs, reached $1.1 trillion. Global CDO issuance was hundreds of billions annually. This massive scale meant that when the market collapsed, a significant portion of global bank capital was wiped out. 2024-2025 market size issuance. Global SRT issuance for 2024 is estimated between $28 and $30 billion. Outstanding volume. The total size of outstanding SRT notes is approximately $70 billion. Underlying assets. While the notional amount of hedged loans is much larger, over $1 trillion since 2016, the placed risk tranches sold to investors are a small fraction of the 2008 CDO market. Growth trajectory. The market is growing rapidly, with US issuance notably doubling in 2024 after regulatory clarity. However, relative to the total capitalization of the global banking system, it remains a niche area compared to 2008 exposure. Future outlook, 2025 and beyond. As we enter 2025, several trends are shaping the SRT landscape. US market awakening. The US market is expected to converge with Europe. The Fed's September 2023 clarification on directly issued CLNs removed barriers for US banks to use SRTs for capital relief. This will increase participation from US regional banks and global institutions. STS standardization. Extension of STS criteria to synthetic securitizations in Europe is encouraging more standardized issuance, potentially broadening the investor base beyond specialist funds. Regulatory scrutiny on interconnectedness. Regulators are closely monitoring the back leverage issue. We can expect stricter supervisory guidance and reporting requirements on how banks finance SRT investors. Asset class expansion. While corporate loans remain dominant, banks are increasingly looking to transfer risk in other asset classes, including commercial real estate and consumer loans, to manage concentration risks. Conclusion: from fragility to resilience. The comparison between 2008 CDOs and 2024 SRTs reveals a financial system that has learned important lessons but hasn't eliminated all risks. Similarities: both rely on the fundamental technology of pooling and tranching credit risk. Both involve transferring risk from regulated banking balance sheets to the shadow or non-bank financial sector. Both are susceptible to leverage and correlation risks, especially during systemic stress. Differences. Motivation. SRTs are driven by regulatory capital constraints, Basel III, not funding arbitrage. Structure. Modern SRTs are simpler, more transparent, and typically reference core banking assets rather than subprime resecuritizations. Alignment. Strong risk retention rules and the synthetic nature of SRTs ensure banks have skin in the game and maintain relationships with borrowers. Regulation. The permissive regulatory environment of 2007 has been replaced by a rigorous supervisory framework requiring quantitative proof of risk transfer, the final verdict. SRTs currently represent a more robust and stable iteration of credit risk transfer compared to their 2008 predecessors. They serve a legitimate function by allowing banks to manage capital efficiency, thereby supporting credit provision to the real economy. However, emerging risks related to interconnectedness through back leverage and the migration of risk to less regulated sectors like private credit and hedge funds require constant vigilance. The next crisis likely won't look exactly like the last one, but the circular flow of leverage remains a common threat requiring sophisticated monitoring. The SRT market is not a replay of the CDO bubble, but rather its complex evolution. Therefore, sophisticated oversight is essential to ensure risk is genuinely transferred, not merely disguised. Thank you for your attention.